Friends, I think there is some problem with the connectivity. I think this is the signal went off. Let us just wait for a minute for our friends to join in. Okay. All right. So let's continue. I think there was some problem with the connectivity. Fine. Yeah. So now let's move on to the next question. So if there is anybody else who has questions, please post them here. Otherwise, I will continue with the questions which I already got in mail. So the next question that I received from, who is this? Pratimesh. I hope I got the name correctly, but anyway. So the question is, when should entire creditors be transferred to internal reconstruction account, and when should only some part of creditors be transferred to internal reconstruction account? It's a great question. I'll tell you why. It's one of the areas where students make, or many people make mistakes in internal reconstruction. What is that point? There are creditors. The creditor balance is, say, 1 crore or 1 lakh rupees. For convenience, let me say 1 lakh rupees as the creditor balance. That 1 lakh of creditor, the question says, creditors agreed to surrender the entire share in lieu of 25% worth equity shares. Something like that. Now, what that basically meant is 1 lakh is the value of creditors. Entire 1 lakh, imagine in the balance sheet, you have share capital, below that reserves, after that creditors. Now, what creditors simply told is, I will make my entire creditor balance zero. I will make my entire creditor balance zero. Give me 25% of that worth as shares. So what will happen? 1 lakh rupees is in the creditors, and share value will now be for 25,000 worth. What happened to 75,000? 75,000 definitely is sacrificed from the creditor side. There is no doubt about that. I'm repeating, 1 lakh rupees is the creditor balance, and basically creditor said, we will completely leave out our rights what we have, and we want equity shares for 25% of the creditor balance. So what happened is, the creditor balance is at 1 lakh. Now creditor balance of 1 lakh should fully go. And out of creditor balance of 1 lakh, 25% you calculate. 25% means 25,000. For 25,000, share capital should increase. That is the crux of what is given in the question. Then, how should you deal with it? Creditor balance today, from 1 lakh, you are making it zero. When you make it zero, where will you transfer this creditor balance to? You will transfer this creditor balance to internal reconstruction account only, or capital reduction account if you are used to calling it like that. So you will transfer that entire 1 lakh to capital reduction or internal reconstruction account. After you transfer to capital reduction or internal reconstruction account, then that out of 1 lakh transferred there. So basically you debited creditor with 1 lakh, credited capital reduction or internal reconstruction account with 1 lakh. Out of that, now 25,000 will get reduced from capital reduction or internal reconstruction account, and it will go into share capital. So that is why you feel that, only when 75% of creditor balance is sacrificed, why are we writing off, or why are we transferring entire creditor to internal reconstruction account? That is the doubt what was asked. Very good doubt. So the point you need to bear in mind is from creditor's perspective. If I am the creditor, earlier I had 1 lakh rupees worth, 1 lakh rupees, I was a 1 lakh rupees creditor. Now I am a 25,000 rupees worth shareholder. 25,000 rupees worth shareholder. So basically, what did I sacrifice? I sacrificed 75,000. But how much of liability did I sacrifice? I sacrificed 1 lakh of liability. Please understand this logic very carefully. I sacrificed 1 lakh rupees of liability, but the net sacrifice what I made is not 1 lakh rupees. Liability I sacrificed 1 lakh. I got equity share capital worth 25,000. So net if I look at it, the net sacrifice is only 75,000. But that 25,000 what is there is not as a liability. That is why entire liability will transfer to to internal reconstruction or capital reduction account. And this amount of 25,000 we will create out of this capital reduction account and credit to share capital. So what journal entry will you pass for that? Internal reconstruction or capital reduction account debited 25,000 to which account? Equity share capital 25,000. I hope you are clear about this logic. But if the problem tells you, see, this is a very important adjustment as I told you. If the problem tells you that creditors agreed to forego 25% of their claim, creditors agreed to forego 25% of their claim. Balance is to be settled over time, something like that. So creditors agreed to sacrifice only 25% of claim. Creditor balance was 1 lakh. Out of 1 lakh, what is 25%? 25,000. Only 25,000 will be transferred from creditor to capital reduction account. So when you are solving problems of internal reconstruction, when any adjustment regarding creditor sacrifice, debenture holder sacrifice you see, ask yourself this question. Say, this total is the amount what they had. Okay, this total is the amount what they had. This is now split into two parts. This is sacrificed. This is still settlable. This is sacrificed. This is still settlable. For whatever they sacrificed, are shares being allotted, or for whatever is the balance settlement that has to be made, are shares being allotted. Listen carefully to this logic. Total payment, what we had to make to creditors was 1 lakh. Now, we are dividing this into two parts. Ultimately, we have to settle 25,000, 25% of that means 25,000 to creditors. So 25,000 to creditors and 75,000 is here. The question what you have to ask yourself is, shares of 25,000, whatever are being allotted, are they being allotted because you are sacrificing the 75,000, or are those shares being allotted because this 25,000 still needs to be settled? If the answer is, the shares are allotted because you are sacrificing 75,000, then you know what? Then you need to be allotted shares for 75,000 value. But if the settlement is only for 25,000, then what? Then the settlement will happen only for 20,000 of shares. So just watch out this point. Understand this carefully when you are dealing with this in the exam. If you still have a doubt in this, please write to us. We'll clarify it for you. Right. So if there is any other doubt, please keep posting in the comment section. All right. Okay. So the next question is, sir, when debentures are issued, why are they not considered in purchase consideration? Good point. I think I just briefly touched upon this some time back. When you are giving debentures to settle, in the old company, say old company is called B Limited, new company is called A Limited. A Limited is giving shares to settle the shareholders of B Limited. A Limited is also giving some equity shares. It's also giving preference shares. It is also giving debentures. Okay, it is also giving debentures. Fine. The purchase consideration, whether to include something in purchase consideration or not, is not just based on what A Limited is giving to B Limited. It is based on what A Limited is giving to the shareholders of B Limited. Why do I say that? Listen, what is A Limited really purchasing? A Limited is purchasing something called as net assets. What is A Limited buying? A Limited is purchasing net assets. What do I mean by net assets? All assets, of course, other than any fictitious assets, minus liabilities is what we mean by net assets. So assets minus liabilities is what A Limited is purchasing from B Limited. So net assets is what A Limited is buying from B Limited. So if I consider in balance sheet of B Limited, assets minus liabilities, what is left out? Only capital. Basically, what is left out? Equity shareholders, equity share capital, preference share capital, reserves and surplus. Only that will be left out. No. So whatever settlement is happening is basically happening towards equity and preference shareholders. Are you clear about this logic? First of all, right. Now move to the next point. Here, when you make some settlement to debenture holders, why is it not considered as a part of purchase consideration? Now you see, if I am paying something towards debenture holders, I am making some payment to debenture holders. From new company A Limited, will our asset go down? Yes, asset will go down. Then the net asset had some liability, right? That liability is debentures. Will that debenture liability also go down? Yes, debenture liability also will go down. So basically what is happening? Our cash or some asset is going down in the new company and liability is getting out of the old company's books. So basically at an overall level, are the net assets changing because of this is my question. No, net assets don't change because of this. So basically you are only settling the liability which is a part of net assets. I am not talking about that to determine purchase consideration. So purchase consideration is whatever we paid to the shareholders. Okay. So when you talk about whatever is paid to shareholders, you will only consider to equity shareholders. Whether you pay equity shares or preference shares or debentures or cash, it will be called purchase consideration. To the preference shareholders, whether again you may pay even to preference shareholders, you can give equity shares from new company. See, I know this is one other psychological problems our students have. When you have equity shareholders, you will always assume that from new company, you will get equity shares to settle the equity shareholders. Who said that? Not required. You can give equity shareholders to settle the equity shareholders. You can give preference shares to settle the equity shareholders also. Similarly, if you have preference shares of old company, you can give them equity shares. You can possibly give them preference shares also. Both are perfectly all right. Okay. So considering that, the amount whatever you are paying towards debentures, that will not be considered as purchase consideration, because with that that is not towards capital, that's not towards net asset related in that sense. Because of that, asset is going down, liability is going down. So that is why you don't have to consider that as a part of purchase consideration. Fine. So I mean, in other words, if I'll just put it this in another manner. Are debenture holders the owners of the company? No, they're not the owners of the company. Who are the owners? Shareholders are the owners of company. So if I am buying the net assets of company, who owns the net assets of the company? Shareholders own the net assets of company. Acha. If I have to buy those net assets, to whom should I make settlement? I should make settlement to shareholders. That's it. You got the logic. So if I am buying your house, I need to make settlement to you. That's all. So that amount what I am paying to you is what will be called as purchase consideration. Okay? Right. So that is one point regarding why debentures should not be considered. And friends, as I told you, just post your doubts if you have any in this question. Then, sir, what is the reason for making a complicated journal entry for amalgamation in the nature of merger? I don't exactly understand what this means, but let me try to let me answer it based on the best of what I understand this. See, when you do amalgamation in the nature of merger, look at what is happening in the balance sheet. First, at a balance sheet level. In the old company, you have all the assets, right? Then you have liabilities. Then you have equity share capital, preference share capital, reserves and surplus, everything you have. Now, out of all this, what is coming into new company? If it is amalgamation in the nature of merger, then assets will come into new company, liabilities will come into new company, then reserves and surplus also will come into new company. I'm repeating, reserves and surplus also will come into new company. So then what is not coming into new company? Only paid up share capital will not come into new company. I'm repeating, what will not come into new company? Paid up share capital of old company is the only thing which will not come into new company. That is why we have this adjustment. What is the adjustment we do? What is the purchase consideration amount? Say purchase consideration is 100. Okay. Then the paid up share capital is, say for example, is also 100 for easy sake, for the ease of solving. Purchase consideration is 100, paid up share capital is also 100 in the old company. Then you are giving 100 and settling the purchase consideration as purchase consideration and settling them. Whom are you settling? You are settling the shareholders. Exactly worth 100. Perfectly fine. Okay. Right. Now go to the next case. 100 is a purchase consideration you are paying, but the actual paid up share capital is only 80. So you are paying extra. You are paying extra. And the question is, why are you paying extra? If you are paying extra, then the problem is, why should, in the core logic of amalgamation nature of merger, what did we say? A should not make profit, B should not make profit. It should just be that you are coming together and doing business, that's all. So here, if one party is paying more than the paid up capital, then there is some excess payment. For that excess payment, that extra needs to be subtracted from the reserves. Whose reserves? Free reserves of selling company. Then if selling company doesn't have free reserves like general reserve, P&L, if selling company doesn't have, then that amount will be subtracted from the P&L and general reserve of the purchasing company. And if purchasing company also doesn't have that, it will be debited to the P&L account of purchasing company. That is what you need to understand. Okay. Now, the third point, which was not answered in accounting standard 14, this came from expert advisory committee opinion. What is the expert advisory committee opinion here? Listen carefully, friends. There is a question. 100 rupees is the paid up is the purchase consideration. And out of 100 rupees of purchase consideration, the amount what is paid up capital is 110. 110 is paid up capital, but we are paying only 100. Now, in such a case, what should I do with that 10 rupees? That 10 rupees we are paying less, right? That 10 rupees, whatever we are paying less, should be considered as capital reserve. Earlier, there was confusion. Should I consider it as capital reserve or should I credit it to P&L account? After expert advisory committee clarified, now there is no confusion. It should be credited to capital reserve. All right. So that is the other doubt what one of our students had. That also got resolved. So these are the questions which I have with me. If anybody has any more doubts, you can shoot them out here, or otherwise, I think we can conclude our webinar. And I also encourage you to feel free and post. If you want webinar on any topic, you can feel free to ask for it, and we will find time to schedule a webinar on that topic also. So if you have any recommendations that you want a webinar on some topic, you're finding it challenging, etc., feel free to do that, and we will definitely support you by conducting a webinar at an appropriate time. All right. So thank you very much, friends, and I hope you have enjoyed learning some more interesting aspects of amalgamation. We took approximately 10 questions today, and thank you very much, and good luck with your preparation. And for any doubts what you have, feel free to reach out to our team, Indigo Learn, and we are always in service of students. Thank you very much.